Let's have a session on income elasticity of demand, sometimes referred to as YED. So this essentially measures the responsiveness of demand to changes in income. Income this time, not price, as it would be in price elasticity of demand. The formula for it, for YED, income elasticity of demand, is percentage change in quantity demanded divided by percentage change in income. Now, if we just go through an example, so if incomes in an economy increased by 20%, and that led to a particular product or a particular good increasing in its quantity demanded by 40%, so twice as much as the increase in incomes, then plus 40 divided by plus 20 comes to a coefficient of plus 2, positive 2. So this is an example of a positive income elasticity of demand, a positive correlation between incomes and the quantity demanded or the sales for your product. So if it's between 0 and 1, this coefficient, sometimes referred to as a normal good. And if it's higher than 1, it may be referred to as a luxury good, such as a foreign holiday. So essentially, the higher the income elasticity coefficient, the more responsive demand is to incomes. Now on the other side, that's a positive example. Let's look at a negative example where there's a negative correlation, because YED can be a positive or a negative number. So in this case, incomes fall by 20% in an economy. Perhaps there's a recession, and it leads to a 40% increase in quantity demanded. If we chuck those numbers into the formula, this formula up here, plus 40 on the top, divided by minus 20, because incomes fell by 20%, plus 40 divided by minus 20 comes to a coefficient for your YED of minus 2. Minus 2, so that's a negative correlation. If the number is less than 0, it's a negative correlation and it's referred to as an inferior good. An example of an inferior good is value baked beans, because they may be more in demand when incomes fall in a recession. So why is this all important to know this? Well, if you know your YED or you can estimate your YED, then you could follow a chain of analysis as so. So let's just say you know your YED, is plus 3, or you estimate it at least that it's plus 3. Plus 3 indicates there's a positive correlation, likely a luxury good, like those foreign holidays we saw over there. So now, you perceive down the road a recession is going to happen, and a recession is going to happen which may well lead to incomes falling. And let's say you estimate that incomes are going to fall by 10%. So incomes are going to fall by 10%. You know your YED, or you estimate your YED is plus 3. Well, that means if you just reverse up that formula, it's going to mean that quantity demanded based on your estimates for your product is likely to fall, because a recession is down the line. You are a luxury good, it's a positive correlation, quantity demanded will fall by 30%. So what does that mean for a business? Well, it might mean that you need to start reducing your inventory, reducing your stock, because you don't need as much stock if you forecast the future's not looking so rosy for you. Other stuff, it might be that you reduce your workforce, you reduce your head count, your staff count. Maybe you need to do some form of retrenchment because you can see forecasting down the road, it's not looking good for you because you know your YED. And the last thing is, if you perceive this is going to happen in this scenario, it might mean that in the future, it looks like your cash flow is going to be in a worse situation than it is now. So you might want to consider getting those sources of finance in place, such as a bank loan, or if it's available to you, to issue some equity. So I hope that helps on income elasticity of demand, and I'll see you at the next sesh.